Good afternoon, and thank you for being with The Real Deal. I'm Hiten Samtani, TRD's associate publisher. On the eve of voting for the CARES Act, the $2 trillion stimulus package, Senator Chuck Schumer said, he promised the country that help is on the way. But what sort of help can the real estate industry expect? Well, to discuss this right now, I'm joined by two market experts who are going to help me break down what the stimulus package, which is the largest of its kind in modern American history, what it means for developers, for landlords, for brokers, and for the market at large. So I'm really delighted to have with us, and I really appreciate your time and expertise, Stuart Saft, who is the head of the real estate practice at Holland Knight. And so Stuart's been in the game for a very long time, and I had to fact check this twice. He has authored 40 books on commercial real estate. Stuart, thank you for being with us.
My pleasure.
I've also got with me Jonathan Miller, who is the CEO of appraisal firm Miller Samuel and one of the most renowned experts on the national residential market. So, as journalists, we're taught to try to diversify our sources. So I always tell my reporters, okay, can you please go and find the Jonathan Miller substitute? I'm sick of seeing his name in our publication. But it's been years. We haven't had much success. So here he is. Jonathan, thank you for being with us.
It's a pleasure to be here. Thank you.
I also appreciate everyone tuning in. Everyone here right now is a Real Deal subscriber, so you obviously know the value that our content has. You know that what we try to do every day is bring you the unvarnished picture of what's going on the ground. As you can imagine, right now, that means we're going 24/7, and we'll continue to do so as long as this lasts. Since you are subscribers, if you could, please tell your friends, please tell your associates and colleagues to subscribe to The Real Deal. We'll provide as much news, intelligence, and analysis as we can. So thank you for your support. We'll get started with both of you. I think, as they say in Sunday school, shit is getting real right now. Right? And we're in a place that we haven't seen in our lifetimes, certainly not mine, but I don't think any of yours. And I want to understand this $2 trillion stimulus package that we have. It's the largest of its kind, as I said. But is it, Stuart, do you think it's just a first step, given what we're dealing with?
Yes, I think it has to be the first step because we really don't know where this is going. This, as you said, this is an event that has never occurred before, and it is extreme. It was extremely heartening to see that the Republicans and the Democrats could get together to put something together. There's not much of it. I'm sorry?
Relatively quickly as well.
Very quickly. And there's not much of it that's directly helpful to real estate, and we can talk about that separately. But it demonstrates the recognition that the losses suffered in the stock market would have, if not dealt with, a cascading effect on the rest of the economy, because we weren't really on the precipice of a recession before this happened, but this is such a devastating event, which isn't ending quickly, that it could very well push us into a recession. So the $2 trillion accomplishes two things. First of all, it gives solace to the credit markets and to the consumer that the government is paying attention and is ready to do anything. And it's interesting because the Federal Reserve immediately pulled out the quantitative easing, which they used to get us out of the Great Recession also. So nobody's wasting any time. And the other thing that it does is it gets money into the pockets of individuals and business so that to avoid people being laid off. Mm-hmm. And the reality is that this will end. It's a horrible nightmare as we live through it. But in all probability, in 3 months or 4 months, everything will be back to normal. We'll have a second quarter that will be dismal and a third quarter that will be dismal. And I anticipate that if everything works, by the fourth quarter, things will be improving. And that $2 trillion is intended as a symbol that help is on the way. Real estate is going to have other problems as a result of what's going on. And you can see that that if too many businesses get into financial trouble, if too many people lose their job, the office market could be hurt by it.
There's already a question of reckoning and rethinking office space, right? A lot of people are saying, well, why should I pay the kind of rent that I'm paying? Do I need 40,000 square foot floor plates? We'll get into that. But Jonathan, just so when the last crash happened, a lot of the financial support, or the majority of it, went to corporations, banks, you name it. And there's been a lot of pushback that still exists today on some of those steps that the government took. This one seems, do you think that partially what's going on is a reaction to the blowback that, it was more focused on the companies. Now it's very much focused on small businesses and individuals, quote unquote, the heart of America, right?
Yeah, in many ways it feels like the opposite. So during the financial crisis, it was all about keeping the banks solvent. We didn't see a lot of for example, new development go under back then because the Fed, FDIC allowed banks to not have to mark to market in terms of like reduce the value of the assets on their balance sheet so they would still be solvent. Stuart makes a lot of good points about, sort of we have to go through this and, the challenge is the getting through this versus, what's at the end of the light at the end of the tunnel, even though we don't have a light at the moment. I actually do think we're in a recession right now. And I think it's good. And everything I think everything is determined by how long does the virus spread until it peaks and we see a noted decrease, and we have that removal of the state's order of shelter in place, or whatever variation of that is, and then that determines how much damage there is to the overall economy. If we have an unemployment, pick a number, 10, 15, 20, 30, whatever the number is, that has the direct ramification on how the real estate market's going to perform. So I think, I think we don't even know yet what's going to happen to the economy, other than we're very concerned about it, and then housing is sort of in lockstep with that. So it's this uncertainty. One other point is that the part that feels most different to me about this versus other crises that we've been through, being in Manhattan and me being just maybe 2 years older than you, Hiten, is that I went through 9/11, I went through Lehman, and the similarity was sort of vacant streets, or lightly, not a lot of pedestrians out there, so there was sort of an element of emptiness to it. But what was different in those two events than this event for me is that there was a moment of time. There was a September 12th, 13th, 14th, and then every day you sort of psychologically got away from the horrible event. In this one, we don't even know when, we have some understanding or some gut feel about, this is going to last, like Stuart said, a couple of months, 2 or 3 months, maybe, but we don't know that for sure. And so we're uncertain, and we're all, many of us are sitting alone or, by ourselves. We're isolated. And so it just makes it that much harder to sort of process. Anyway,
it's really unusual times when you need to quote Donald Rumsfeld, right? But this is the known unknown. This is unknown unknowns. It's just a very strange time. I will, at some point in this conversation, zoom out, talk about where the market is. But let's get into the CARES Act itself, stimulus package. What was the most...
Well, before we get into the CARES Act, I want to comment on something you said, and then a point that Jonathan made, and I think it's important. And you had said that everybody working remotely is going to hurt office space, and I assumed the same thing the day they closed my office, and I had to invent a real home office where I could communicate with clients and everything like that. And one of the things I do, because I have an open door policy in the office, is I have every morning a 9 a.m. conference call, and anybody in my group, lawyers, paralegals, secretaries, who wants to call in and just talk about what's going on, does, and it's worked very well to keep the group functioning as a group. The one thing that I've heard repeatedly is that nobody wants to work remotely except in this emergency. Everybody is looking forward to getting back. And in point of fact, one of my partners who suffered through New Jersey Transit said last week that she never thought that she would look forward to having to take New Jersey Transit.
You do that now, and we will get into the broader stuff. But
Right. Let me just make one other point, and it's something that Jonathan said about a recession. And I have always believed that the biggest mistake that business can make when you're in a recession or when stock prices go down is laying people off.
Mm-hmm.
And so in my career, there's been multiple recessions, and I've done everything possibly to keep my staff together. And the reason is that that in a traditional downturn, Wall Street corporations lay off millions of people and their stock goes up. My position always has been that the problem is that no one has on their balance sheet the knowledge of your employees. So in reality, when all these companies are laying people off, their stock should go down because basically 1,000, 10,000 years of knowledge is walking out the door and going somewhere else. So one of the positive things about the CARES Act is that every employer basically is being given
incentivized
money they would have made by laying people off. And that is incredibly thoughtful doing it that way, because the worst mistake we can make is laying everybody off. You have to keep your staff because they're the ones that made your business successful. And in point of fact, when Dewey and LaBeouf went out of business, and I met with other firms, and when I went in and I said, I'm bringing my group, and they said, well, we have lawyers that can support you. I said, no, you don't understand. I didn't build that practice. We all did. So I'm not going without my group.
Yeah, and as to your point, I mean, incentivizing businesses to keep employees is sort of the master stroke of this so far. And I was speaking with Revenue's Jim Whalen, and he made a similar point as well. But let's go to the bill, because that's what our readers are here for at the moment. What is the most heartening aspect besides what we just talked about, which is it incentivizes employment? Where do you see the most direct relief for industry stakeholders?
It's difficult to pinpoint specific provisions in the Act that help industries other than the airline industry, where there's very specific provisions to assist them. There's provisions to help businesses deal with the impact of the coronavirus. There is some tax advantages, but really minimal, allowing people to draw against their IRAs without penalties. It postpones some deadlines that would otherwise be in the way. But there really isn't winners and losers as far as this bill is concerned. And I think Congress was very careful to make certain that there weren't winners and losers. And interestingly, as we all know, real estate, although people make huge amounts of money from it, also lose huge amounts of money for it, because it's not as liquid as a stock and bond portfolio is concerned. So if in fact we go through a heavy recession, real estate will suffer greatly, and there probably will be a bailout of the industry one way or the other. But I think that real estate was purposely left off of those industries that were going to benefit from this bill, because I think both the Republicans and Democrats were sensitive to the fact that the president came from the real estate industry. The president ran a hotel company. And I think they purposely said, you know what, we don't want to be criticized. We want to solve this problem. And we don't want anybody saying that somehow the president benefited from it. And I think real estate was put on the side. And the thought is let's see how things play themselves out. And if real estate needs help, we'll deal with it separately. But let's try to keep everybody together going through this crisis. The reality is, it's really the first time since 9/11 that there has been a crisis that has gotten the American people together. And it's incredibly important that this happened that way, and there aren't winners or losers. And the reality is, if you look at where the virus is spreading, it's pretty much the east, the south, the north, the west. The whole country is affected.
Yeah. Everyone's in this together, and it's an interesting point you make about leaving the real estate industry aside, because there have been things that have come up since this administration, like opportunity zones, which are been heavily criticized for being giveaways to the real estate industry. Jonathan, your take on sort of when you perused the bill and looked at what were some of the big things that jumped out? Anything in the mortgage market or for residential owners?
Yeah. I mean, and it's part of the bill and also part of the change in the regulatory environment in Washington with the concept of social distancing. One of the problems with our appraisal firm and my colleagues across the country is that we saw this big Fed rate cut, 0.5% on March 3rd, and then another full percent to zero on March 15th. And that's, sort of the moment I think that this became tangible to the housing market specifically, where we saw things change dramatically, like a light switch went off. And one of the problems has been is that we had this big rate cut, and it didn't translate initially to lower mortgage rates overall, but it has, and there are some lenders that are really cutting rates and trying to get business. The problem is that within the valuation industry, they require an interior inspection, and as of 2.5 weeks ago, the vast majority of my peers across the country stopped agreeing to go into properties. Mm-hmm. And that created a problem in liquidity, that we're trying to keep things flowing moving forward, but yet you have to physically put someone in harm's way for someone to save money on their mortgage. And so what we've seen, and this is sort of in parallel with the CARES Act, I'm sorry, it's not directly, but it's such a big thing, I don't think people realize it, that all the regulatory agencies in Washington, when you think about the alphabet soup of agencies, VA, FHA, FHFA, which is oversees Fannie and Freddie, you name it, OCC, you name it, there's so many agencies involved. They literally all scrambled and came together within a couple of weeks and created mortgage alternatives that would allow, say, an appraisal firm to do a drive-by or a desktop, something other than physically going in to try to keep the liquidity going. But what they didn't really do is allow this same sort of, lack of interior inspection required on refis, because if there is a large value drop, someone that might have an 80% mortgage that's trying to refi it to save money or pull cash out on a cash out refi. Mm-hmm. Now it's really not an 80% mortgage because it's a drop in the market. Maybe it's 100% mortgage or 110% mortgage. So they were also very concerned about putting the entire financial system at a significant risk. So that's where we sort of end up right now.
And Stuart, one point that came up, but I still getting mixed feelings on whether it's a big deal or it's just been made to be a big deal, which was the Times had a story about a potential bonanza for real estate investors. It had to do with lifting the caps on depreciation. Like you could typically offset losses, including depreciation, up to $250,000 for single filer, $500,000 for a joint filer. That restriction has been lifted for 3 years. And they've talked about that being a potential bonanza. I don't know what the Times looked at, but they said they valued that at $170 billion in potential savings for real estate. Let's get your take on that. Is that really what is happening? Because we're hearing mixed things about that.
It's not really what's happening, and B, it basically corrected a mistake that was made in the 2018 Act. By but by accidentally putting a restriction on that wasn't intended to, it was just bad drafting. And so it was felt that this was the time, and particularly the environment, that it should be corrected for a limited period of time. I don't know how the Times came to their valuation, because it's a very, very narrow change that has a very limited impact on virtually any business. So I haven't, I didn't read the article, but I know the change that was made, and it was just a temporary correction of something that was done in 2018. It wasn't that they've changed long-standing policy to accomplish this.
Got it. I can see a lot of people who've been tuning in the last 10 minutes. So just to catch you up, we're with The Real Deal. I'm Hiten Simtani. I'm joined by Stuart Saft from Holland Knight, Jonathan Miller from Miller Samuel. We're just discussing the stimulus and what it means for real estate. Thank you for being subscribers. We're also going to talk a little bit more broadly now about the market. So, Jonathan, when we're dealing with brokers and brokerages, we're dealing with hyper optimists by nature, right? And they're not necessarily, our sense is they're not necessarily really reckoning with what's going on, right? This is being called temporary blip, a 6-week sort of slowdown. Spend time with your families. This is when you connect with your loved ones, polish up the books. But is that a fair assessment of what you're seeing and what you predict?
So my first answer would be, well, if it makes them comfortable and happy at this point when you're trapped in your house, have at it. But I don't think that when you have a real estate, it's sort of like with the mortgage market with liquidity. When you have a real estate market where there's literally a handful of contracts in a large market any given day now versus hundreds before, and even many of those contracts, a lot of the contract data we're looking now might have been the meeting of the minds might have occurred before the March 15th or the mid-month, the sort of, where buyers and sellers haggled, and then the agents, work with them, and then it goes to the lawyers, and it might take 2 weeks or whatever the time period is. So we don't even know, but I think the expectation is that there's not going to be much activity at all next month, even if the governor of New York ends up signing off, and Stuart probably knows better than me, but yesterday, the shelter-in-place rules for real estate agents were essentially undone.
There's been some mass confusion about that. If I can jump in, there's been some mass confusion. In fact, while we're having this conversation, our reporters are unpacking what exactly happened. So the story that you may have seen last night may be very different today. So
yes, exactly. Right. Exactly. And that's actually part of one of the biggest problems during this crisis in general has just been uncertainty about what's going on. And, one of the things that happened is that the real estate industry, the brokerage specifically, were deemed non-essential. And then that's being undone. And, I don't think that's official yet, but I believe it's being, that was the new discussion that came out yesterday. And so what that's doing is, here we have this shelter-in-place concept that in theory is working, that is bringing down the growth of the virus. The data that we're getting is actually lagging by a couple of weeks, really, in reality, between when you could have been infected and when you're actually being tested. So we're sort of looking at this at a fairly large lag. But this seems to be a good thing, and it's a great irony, because the longer the real estate industry stays in their homes, the less damage there will be to the real estate industry, as we look down the road. So that's a problem. Just one other, I'm sorry, I'm being a little inconsistent here, but with the CARES Act, just in the reference, one of the things that I wanted to mention, and this sort of fits into the discussion about whether shelter in place is going to be lifted for the industry, is they can, with the CARES Act, I believe they can collect unemployment insurance as independent contractors, which is huge. And so one of the sort of theories that's being floated around is, this was a way to save on unemployment by sort of reversing and making them essential businesses. They can conduct business. I don't believe that, but I'm just saying this uncertainty that's floating around is really not productive.
I think there is a whole ethos in the brokerage industry in general, which is eat what you kill. No one gives us any handouts. Nothing really comes to us easy. This is probably the first time we're seeing that they will be able to avail of some of this relief, which is a very, very big thing for a lot of brokers out there. We're not talking about the brokers who bank multi-million-dollar sales and then have the ability to sit for 6 weeks. The majority of brokers in New York, across the country, are living, deal to deal. So it is
the median income of a realtor, a NAR, National Association of Realtors, is about $41,000 a year.
You have that number for New York?
I don't believe so, but I certainly can try to find it.
I'd love to know that. Stuart, you're dealing a lot with, you represented developers of some of the glitziest condo product out there, as well as across the board. Mm-hmm. What sort of conversations are you having at did you get a lot of calls once this CARES Act passed, or was in the process of being passed, about what's in it for them, and what sort of, if you could share a little bit from those conversations?
Absolutely. But first, as you know, I've taken it upon myself basically to go into the news business because I know you have so much fun. Mm-hmm. And I have been sending out alerts to my clients with regard to the governor's executive orders, what Rebney is doing, what's been in the CARES Act, and writing it in plain English so other than law professors can understand it. And so it's a constant flow of information in a readily usable fashion, which I felt with a lot of the things that are being done was missing. And I'm getting a tremendous...
When you subscribe to The Real Deal, we'll also include Stuart Saft's newsletters as a bonus. It'll help you. But Stuart, go ahead.
But interestingly, I have, as I indicated, 40 lawyers spread out over 3 states working remotely. And I had the firm put together a program for me a number of years ago as a practice group leader to look at everybody's time on a daily basis, because I felt I couldn't really manage finding out what people's time was a month later. Mm-hmm. And so it's very handy in the last 2 weeks or 2.5 weeks since the office is closed. And I would say that with everybody working at home, virtually across the board, people are putting in perhaps 20% less time than they were putting in the office. Everybody is incredibly busy. And April may be different than March, but March, including the last 2 weeks, nothing stopped as far as our practice. I don't know how other firms or other real estate practices are going, but I know that I sit down at this desk at about 8 o'clock in the morning, and I'm sitting here until about 8 o'clock at night, and the things going on. We started doing remote closings 2.5 weeks ago for our clients. And the first week we did 8, and we have 17 scheduled for next week. And so, yes, there are people who want to back off and wait to see if the world is coming to an end. Mm-hmm. But by and large, we're seeing clients say, we negotiated this deal. We want to move forward with it. And in point of fact, yesterday, we got 2 new deals come in. And so I put a team together, we reviewed documents last night, and we had conference calls with the clients today. So things are still happening. And as I said, perhaps it's a follow through as to what was happening in January, February, and the beginning of March. But I don't see I don't see this tremendous the economy falling off a cliff like what happened when Lehman collapsed. And if you think about how many, and I'll use my home as an example, I'm a regular stop on Federal Express and Amazon delivery service, and I believe that most people are also that they're in their homes all day long, but they have plenty of time to go online and order whatever it is they think they want. And that demonstrates to me that the economy is still strong and people still have money to do that. I'm sorry I interrupted.
You're being the optimist, but what I need right now is I need the attorney. So please, okay. when the developer calls, or when these things were happening, the developer calls and says, "Hey, Stuart, is there anything in this for me? Was there any solace you could provide them in terms of the CARES Act and the stimulus?"
The solace I gave them had to do with understanding the economics of the situation that we're presently in, and how the government is dealing with this very different. I'm looking at the macro aspect of it. You start off looking at the Great Depression, and no, I wasn't alive when the Great Depression happened, but the Great Depression was as bad and as long as it was because the government thought that there was too much money in circulation and they cut credit, and business couldn't survive. And if you take a look at the Great Recession from a decade or so ago, it started off being just horrendous. And the government was doing the same thing. They basically were pulling money out of the economy. And then they realized, this is wrong. We should be pushing money into the economy and inflating the balloon so that we can keep it going. And that's how we got to quantitative easings 1, 2, and 3. This time, they didn't wait 6 months to see what was going to happen. This time, they jumped right in and said, here's $2 trillion. Now, we're going to give it to you in all these programs. But the fact of the matter is they could have just flown planes over the country and thrown the money out. The idea of the $2 trillion is that you get the advantage of the multiplier effect, which when I took Samuelson in college was $7 for $1. So if that hasn't changed, and of course everything has changed, they basically put $14 trillion into circulation by coming up with a $2 trillion program. And so this is what I've explained to the clients. And, they're sophisticated people. And so far, nobody is really hurt by what's going on. Yes, the stock market has collapsed, fallen, but we all lived through, at least my part of we lived through 1987, where we saw the stock market collapse by 27% in a single day and then come back. And the stock market's going down out of fear. So once we get out of this thing, it'll reinflate itself. Unless your plan is to retire tomorrow, what you have in a portfolio doesn't make that much of a difference. If I ever thought about retiring, the last 2.5 weeks told me that that's just not something I would ever want to do. But frankly, that is what I'm seeing talking to the developers about how the Fed is handling this, and it being the only realistic thing to get us out of what would have ordinarily have been an incredibly steep recession, coming out of the fact that everybody's locked in their homes using the internet to order stuff.
Yeah.
But I mean, that's the reality. And how long do I think this is going to last? When my office closed, I figured 6 weeks.
Mm-hmm.
But if you look at Wuhan, China, where this all started, from the time we first heard about it, in mid-December to when they lifted the restrictions was 3 months.
I think it's a little bit trickier here, and I don't want to, we don't know. America functions very differently to China. I think in China they were able to take some pretty extreme measures quite quickly once they took this seriously, which we haven't been able to take. Think of the spring breakers in Florida, but that's just one example. I wanted to very quickly talk about the CMBS market, if anyone can jump in, but Tom Barak had put out this pretty well read op-ed on Medium. He'd written a post about this essentially being the end of the CMBS market as we know it. He said there's going to be a rash of defaults, and unless the government does something very, very dramatic, this is the end of CMBS. We have already seen a couple of big deals collapse in New York. I'm thinking of the Daily News building, whose Isaac Shatreet was in contract to buy it. His Deutsche loan didn't come together because of the CMBS market essentially frozen, and he pulled out, leaving SL Green with the building and a $35 million deposit. Any solution on the horizon for the CMBS market? Either of you?
Well, I can only tell you that we heard the same thing when Lehman collapsed and we went through the Great Recession. This is the end of the CMBS market, but it's never going to come back. And I was part of a group at Dewey and LaBeouf. We went around to the firm's insurance clients to discuss and financial institutions and discussed with them various aspects of what was happening. And somehow the CMBS market came back again. It came back in a different version than it was. And certainly no one could have predicted how it evolved. But I don't see that happening this time. And I don't see it happening this time because the financial system is basically sound. The Great Recession was all about systemic issues, and the fact that there was excess leveraging and the fact that the banks were all in trouble. This time, all of the big banks were stress tested maybe 2 months ago, and they all did well in their stress tests. The underlying economy is still strong, and I think that it's a blip. And I think what's going to come out of the blip is that we're going to wind up doing the same thing that we did in the last recession, and basically the loans are going to be amended and extended, and then ultimately they're all going to be paid off at par. Nobody is going to pull the trigger. Because
I actually agree exactly that with Stuart that we've heard this before. We heard this during the housing bubble. One of the concerns right now is property valuations as we go into this sort of unknown, that if there is, if you had to sell your home today, not 6 months from today, that, would it be less than it would have been in February? And the answer would be yes. But that doesn't mean it's that way a year from now. And so one of the things that's quite amazing is if you look at mortgage portfolios held, on residential mortgages, the credit scores of the applicants in those mortgages are among the highest in history. Mm-hmm. So I think the concern, just in a general concept, is that valuations in the short run take into account, what's happening on the ground right now. And I think to make a proclamation that any kind of mortgage-backed securities, that's all over, I think is in my view sort of silly.
Got it. I have a question.
And interest rates, I'm sorry, let me just say this. Interest rates are low, and they're going to stay low for the foreseeable future. So what we're going to see is people refinancing out of the old loans into new lower debt loans, which is part of the brilliance of what the Fed is doing.
I have a question in from an audience member, Elizabeth. Elizabeth asks Stuart, do you think that co-ops and condos are eligible for relief specifically under the CARES Act? Has there been any provision made for co-op? Okay.
Yes, I do. They're a nonprofit business. They certainly qualify because they have employees. Co-ops and condominiums do not have to show that, nor does anyone else have to show that they've had a loss. And certainly there will be expenses coming out of this pandemic. Certainly all the sanitizing that's being done, staff members getting sick, increased vigilance over how the building operates. So, in fact, yes, I have no doubt in my mind that co-ops and condominiums qualify. They absolutely should apply because they have nothing to lose, and it's basically free money. Even if the purpose of this money is to incentivize business not to lay anybody off. Mm-hmm. And even if a co-op or a condominium really didn't plan on laying anybody off, there's going to be shareholders and unit owners who are going to be unable to make their payments, so that there'll be internal defaults. And the application is a very simple one-page application to fill out. And my understanding, having spoken to a lot of the managing agents, is that the management companies are offering to do it for the buildings they represent. So, Elizabeth, go get your free money.
That's good to hear. And I think this kind of specific advice right now is what people really need to hear. There's quite a fair bit of anxiety. Another question for whoever it makes sense is, can you please talk about the specific loan and grant programs available to agents, that's real estate agents, under the Act? Thank you. Anyone take that one? Yeah, huh? So I guess where else would people go for resources when this is all we have right now? This bill, is there any sort of the sequel, any addendum, any extra information that will be provided by the government when someone needs to know something like that question?
Well, yes. The CARES Act is less than a week old. And we've gotten a lot of material to look at, but we haven't gotten the actual regulations. And as a matter of fact, the forms only came out yesterday. Yeah. So this is moving ahead very, very quickly. And Jonathan and I can't answer because we're used to looking at 50 pages, 100 pages of regulations and saying the answer is A or the answer is B. And that's getting the regulations out is lagging behind the public the knowledge that this is now available. And over the next couple of weeks, it will be. I also expect to see more executive orders from the governor, because the governor issued 12 executive orders to deal with the immediate emergency. He then has to deal with how to move forward from this point. And particularly with regard to how do we leave the state of emergency? We can't just all of a sudden a whistle is going to go up and it's safe to go out in the street again. But we have all of these regulations that are now in place. So he has to give some thought to how this is going to unwind and over what period of time. And the single most important thing, the single most important thing is stay safe. Mm-hmm. From a business point of view, the single most important thing is to learn from this experience. Okay? We've never had a pandemic before. I can't believe it's the last one we're going to get. And any business, any law firm, any accounting firm that doesn't sit down and analyze what they did this time and how they did it and what are best practices and what they've learned and make that part of their strategic planning and update it regularly is making the biggest mistake in the world, because you don't need a global pandemic to need this information. It's also going to be helpful in floods and in hurricanes and in tornadoes and all the other things that now have become part of our everyday life. Right. And that's what we all need to be looking for. Best practices, so that the next time we don't have to spend 3 months preparing to deal with the pandemic. We know that this is what worked the last time, and hopefully we won't need it, but we'd be foolish not to be prepared for it.
I think for your first point, it's a little bit tricky because when you say, stay safe, be safe, but then the kind of mixed messaging we've had at every level of government, and Jonathan, maybe, we have a mayor who finally said shelter at home, and the night that he gave that order, the day he gave that order, he went to the gym, right? So we have situations like that. Then we have the mayor and governor jostling for position in terms of who says what. So sometimes contradict each other.
There's been a tremendous amount of politics at all levels in this process, and I think the consumers, like the ones that are watching here, just want answers. and they want a single place or a limited number of places to go to just get the same type of wherever they go, there's a consistent message. And if I had to say, that's one thing that I think has been really lacking overall during this pandemic, and I think it's unfortunate. One of the things that I think the takeaways to learn from this is that you're walking down the road and then all of a sudden something changes and you have to adapt immediately. And one of the things, when you think of the long term, and this is maybe a little bit out of the box for the topic of this, but there are millions of people working remotely, and as Stuart said, I understand that you lack something, but I certainly see a sea change of consumer behavior, whether it's commercial buildings, whether it's individuals, really starting to factor in something like this, an event like this. This is different. This seems like a higher probability of recurring again than, say, a 9/11 or something along that line. And remote working, while it's maybe not as efficient now, because it's so stressful, kind of works. And that's something I think we're going to take away from this.
I have a question that I think we've already answered. I'm just going to say the question. I think Stuart has made the answer clear, but the question was, should I lay off my employees now and rehire after I get the loan grant, or keep the employee on payroll? I think we've made our position pretty clear on that, Stuart, right? I think at the moment, try to invest in your human capital, try not to make layoffs unless it's absolutely necessary, and move on from there.
Absolutely, because that person you're going to lay off is going to be the very person that your competitor is going to hire as soon as she or he becomes available. Yeah. Don't give away an asset.
Yeah, the challenge right now, though, is cash flow and the ability for businesses to be able to do it, and that's the crisis. I think that's what's pulling down, and it is one of the reasons why the economy is eroding so quickly, is that we can't. That many of us can't, especially small businesses, large businesses perhaps, but small businesses. If the work stops coming in, and you've saved as a small business for a certain period of time, the CARE Act is something that, could be a lifesaver for a lot of small businesses. And that's actually one of the silver linings in all this, is that didn't happen during the financial crisis. It was all big.
And brokerages, as much as they may like to think otherwise, are often essentially small businesses, right? They have very big margins. They don't necessarily have a 6-month runway or anything like that. As you can see, some of our subscribers saying, hey, they're asking very specific questions. This is all pretty raw, and we're getting our experts together to talk about this, just days into it. The Real Deal has put out a special report breaking down what we know at the moment about what this means for developers, landlords, real estate brokers, and lenders. And the answer really is not much. There's not that much detail at the moment, but this is what we have at the moment, and we will keep crunching that. Whatever we see, we'll keep talking to folks and keep giving you more reporting. But for now, Stuart Saft, Jonathan Miller, thank you very much for being with The Real Deal.